There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Great you can join us here at AusBiz as we wrap up the day and of course the week and what we've seen. Well, let's get to the market and look, it's off by around 0.7% there. Looking at the ASX 200, of course, having hit an intraday record yesterday, it's off 0.8%, having now tumbled below that key 9,000 psychological level, 8,995 in fact for the ASX 200. Well, let's get to the themes of the day. I think fair enough to call it the Friday fizzle. That's where we're at the moment, with stocks certainly fizzling across the course of the day. Also, rare hit. Look, among those stocks, look, I mean, we know what's going on in the resources sector at the moment, particularly as underlying commodity prices have been flying, but it's actually the rare earth miners that have suffered a hit today, including Iluka, which have downgraded guidance there. Also, Lynas among those that are falling. And trade jitters. That's certainly unnerving global markets at the moment. Tensions between the US and China, which appear to be escalating, no sign of a back down. Once again, also that involves rare earths, critical as far as the world is concerned, and China has cornered that market, so that's where that sits at the moment. Well, let's check the sectors. Those that are moving, perhaps the worst performing sector has been found in energy, and that's reflected in those moves there, with Karoon off close to 3.5%, Woodside more than 2.5% lower in today's trade. In the resources sector, well, once again, hard to go past what's going on in the gold space, with gold having hit yet another record. I think it's the fourth session in a row, in fact, eclipsing the $4,300 mark. And as a result, more moves among the gold miners, although it's actually the larger producers that have actually done the heavy lifting today. Some of the smaller producers, explorers and developers, have come off in today's trade. Other sectors we're watching, tech, that's also been hit today. As you can see there, WiseTech down zip, also falling. And I should actually add to Life360 among the worst performers today. And consumer staples, that has managed to hold up relatively well there. In fact, I looked at this not long ago and it was mostly green, but that's actually come off as well. All right, let's catch up with some of those stories then. Iress engaging with new third parties in addition to the ones that have previously expressed interest in the company. Southern Cross Media will appoint an independent expert to assess its plan to merge with Seven West Media. Jason Murray has been appointed independent non-executive director at Adore Beauty. E-Road has warned of an impairment of up to 150 million Kiwi dollars driven by ongoing challenges, particularly in the US market. Well, let's now get across what we have seen this week, and we are joined by Shane Oliver from AMP. Shane, welcome back. Good to see you. Can we start with what's going on in terms of those trade jitters, if you like, between the US and China? Now, a lot of rhetoric from both sides this week. How do you see that panning out? Because we're looking towards that deadline that Trump has imposed on November 8th. Oh, Shane, I think you're on mute.
Good point.
There you go.
I certainly was on mute. I don't know how that happened, but it certainly did escalate after we spoke a week ago. Friday night, we'd already had the China move in terms of rare earths and critical minerals and so on. And then, of course, Trump responded Friday night, Saturday morning, our time. And of course, there's been some moves ever since then. through the course of the week. And in fact, Scott Bessent, the Treasury Secretary, saying that other countries like Australia should decouple from the US. And of course, that's played out interestingly. I think one factor there behind the gold price continuing to surge. Shares have been a bit wobbly, and of course, that's weighed on Bitcoin. So if you're wondering why there's that divergence there, I think that partly explains that. But a broader picture, I think, is that what we're seeing here is a positioning strategy by both sides. I think China started playing it, then the US is playing it as Trump always does. I think the Chinese have learnt from Trump. They want to put their position, make it as strong as possible going into the Trump-Xi Jinping meeting later this month. And I think that meeting will go ahead, but it just seems to me that they're putting these things up so they can give something away. In other words, trying to put pressure on the other side. The threat to decouple from China is part of that. But just bear in mind that Scott Bessent has said that multiple times. If you're worried about the impact on Australia, he has said that multiple times. And back in earlier this year, he actually backed away from it, saying, we don't really want to decouple yet. It's too early to do that. And I reckon there's massive pressure on Trump right now because that tariff roller coaster, the surge into April, the big fall in share markets in April, the pause, and then the now potential rebound. I mean, that is not working very well for him and the electorate in the US. And it partly explains why he was on the phone to Greg Abbott, the governor of California, saying, give me 5 seats in the next year's upcoming elections, because he's getting worried politically that the Republicans will lose control of the House and the Senate in midterm elections. So that's why I think he is under pressure. He has to pivot away towards more friendly policies. That's why I think ultimately he'll try and find an off-ramp here, because when Americans are asked about Trump's management of things like trade and tariffs and inflation, he actually scores quite low. That's not what they see him as being elected to do, and that, of course, is causing pain in the US. So that's why I think ultimately he has to back down. He has to find an off-ramp here. So that's why I'm not overly concerned about it. But these things can go on for longer than you expect. We could see some more volatility before ultimately it gets resolved.
Well, and in fact, let's go back to that first chart with those asset classes. We mentioned gold there, Shane. There's something of an irony perhaps panning out here, and that as the investors looking at bubbles elsewhere and then turning to gold, and lo and behold, are we in a bubble for gold?
That is an interesting observation, actually, because you may have seen last week, I think it was, I did a chart which had bubbles, and one potential bubble there is in AI, and the Magnificent Seven are up 30-fold over the last 10 years, whereas NASDAQ going into the year 2000, 1999, 2000, it rose about 10-fold. So it's leaving that bubble in the dust, so to speak, if it is indeed a bubble. So it would be a bit ironic if investors are saying, well, we're worried about shares because it might be a bubble, we're going into gold, and then it makes that into a bubble. I mean, certainly when you see those images of people still lining up outside ABC Bullion in Martin Place in Sydney, it does make you wonder whether it's become a bubble once a lot of retail investors get involved. I'd be a bit fearful getting back on the bus or the train, with all my gold if I picked it up there. But anyway, you do worry about that. I think the only thing that makes me think there is something more fundamental to it here is that there are legitimate concerns out there regarding public debt levels. Interest rates are coming down. The US dollar is in a downtrend, and all of those things are positive. And we've got these geopolitical issues. All of those things are positive for gold. That said, just like Magnificent Seven, gold could be forming a bubble, but I suspect that notwithstanding a bit of volatility, it probably still has a way to go yet.
Shane, let's turn to what we're seeing locally. And we actually heard from Michelle Bullock. I think it was at Wednesday night our time. She was speaking in Washington. It was somewhat pouring further cold water on the prospect of rate cuts. Then, of course, yesterday we had that surprise jobless number, the unemployment number, I should say. What's your view? Has that changed your outlook on where rates are going to go?
Well, it hasn't. It's just that we hadn't changed them in the first place. So if you go back 3 weeks ago, 4 weeks ago, whatever it is, we expected cuts in November and February next year. We were expecting another one in May, so we have moved that in response to the higher inflation numbers we got in July and August. But we didn't change them as a result of the meeting and the more hawkish commentary from the Reserve Bank, because we thought it is a close call now, but we thought that the broader trend in terms of the jobs market is still one of weakening, and the broader trend in inflation is still one of slowing inflation. So consequently, we didn't change our view. We were feeling nervous about it. We still feel a bit nervous about it, but we've stuck to the view there will be a cut in November. We just feel a bit more confident about it now, as does, it seems, the money market. If you go back to yesterday morning when those comments from Michelle Bullock hit the screen, if you want to put it that way, I think the money market was saying something like a 35% chance of a cut in November. When the jobs numbers hit the screen, well, it bounced around all over the place. At one stage there, it was saying 100% chance of a cut in November. It now seems to have settled down to around 75% chance, which is basically what that chart is implying there in terms of the level. So I think that's a reasonable thing. The money markets obviously change a lot in response to data, just like arguably the RBA does. And you can see it does bounce around a bit there. You can see the end of September rise in those estimated cash rates to very little chance of a November cut, and now a quite substantial improvement. But I think it's still a close call, but I think it's less close than it was 2 days ago. And my feeling would be a lot does depend on the inflation numbers that come out in less than 2 weeks' time. I think if they come in around 2.6 to 2.7%, given the rising trend in unemployment, the RBA would probably say, well, okay, that's close enough, we'll still cut. If alternatively, the inflation numbers on the trim mean, that is, at 2.8 or 2.9, then I think it gets a lot harder and they'd probably decide to wait. Now, there is an argument that the jobs numbers are very volatile month to month. They've used that argument before, but it seems to me quite clear that trend in the unemployment rate is up. You get this little leap every so often. You go from 4.2 to 4.5, then it spends a bit of time churning around. Maybe it'll do the same thing again. We'll fall back to 4.4 or 4.3, and then a few months down the track, it'll have another rise. And that is consistent, I think, with still solid labour supply growth in Australia, still solid population growth, but we are seeing a very somewhat slower trend in employment growth. It's half what it was at the start of the year on an annualised basis. And we're seeing less job openings and job vacancies out there. You can certainly see that in the finance sector, I'm told. And that, I think, is telling us that the labour market is slowing down. We're now at 4.5%. That is above the RBA's forecasts. It's at their own estimate of full employment. If you go much further from here, they start to get a fail in terms of their full employment mandate. So difficult balancing act for the Reserve if those inflation numbers come in on the high side. But our bet is, we will get a cut. But I can see there is still a lot does depend on these CPI numbers when they come out at the end of the month.
And just briefly, Shane, the little Aussie battler stuck around 65 again. It appears that it was getting a bit of a bid there on the prospects of deep US rate cuts, but now, of course, with the prospects that we are going to get more rate cuts here, you see any further upside for the Aussie in the short term?
I do. I think what you're seeing here is just a short-term pullback. Interestingly, this time a week ago, I think we were looking, the money market was 1.5 cuts in Australia. Now it says just over 2 cuts in Australia. In the US, they've gone from about 4.5 cuts, so assuming 0.25% each, to now over 5 cuts. So they've sort of moved in line ball to some degree, but I think the Aussie was hit by that bout of risk off associated with the tariff uncertainty. But I think ultimately you probably will see the Fed cut by more than the RBA does, and ultimately that will, I think, put more upwards pressure on the Aussie dollar. And the Aussie dollar will also benefit to some degree from the rise in the gold price, because we are a big or significant gold exporter. So I think what you've seen is just a temporary pullback. I think, assuming there's not a full-out trade war between the US and China, then I think the trend will resume on the upside for the Aussie.
Shane, great to get across what you're seeing. Enjoy your weekend. Thanks for joining us on AMP.
Thanks, Andrew. Take care.
All right, let's get to our stock of the day. Now, the focus has been on rare earths. They have taken a hit, certainly in today's trade, in fact, over the past couple of days. The stock we focused on was Iluka Resources, and to get across that, we heard from Ben Clark from TMS Private Wealth and Jonathan Takadina from MPC Markets.
I'm happy to buy some and hold for another run up, because I think Trump could say something again and send it higher. I noticed as well. we started trading the US markets. There was a US antimony play. We were trying to buy the breakout. It dropped 30% almost day after, and then if we didn't hold it, we took profits up 30%, but then it shot up another 70% 2 days after. So that's the kind of volatility that we're experiencing. Great for traders, not so much for investors.
Yeah.
So I am a buy, but it's more like a trading setup buy.
So I don't know how you put all that together. Like, it's impossible to know what the profitability of these projects is going to look like. Lynas is the only one that is in production, and if I was in anything, it would be in Lynas, because I think that's the one that is strategically the most important asset. But where it goes from here, like I think Trump really will. I can see the US doing something here. I think they're making all the noises, but how do you value that in a stock? It's too hard.
All right, let's get across the best and worst in today's trade. We shouldn't be surprised that the gold miners are yet again on the top of that list. Emerald Resources, Westgold, another big mover today. Treasury Wine Estate bouncing back, that's up 3.5%. Iress also, perhaps on more suitors, potential takeover suitors there as well. On the negative side, the insurers have actually been hit hard today. QBE leading those losses, down 8.5%. Drone Shield, further losses there. Lots of profit taking going on, given how far that stock has run this year. Life 360 among those tech stocks that are hit today, along with some uranium stocks, including Paladin. Let's check what's out overnight. We will get a read out of the EU, I should say, on inflation. And looking ahead to next week, we get the Chinese Communist Party plenum happening next week, along with a read on Chinese growth at GDP figures. Locally, we will hear more comments from RBA Governor Michelle Bullock, and we also get a read on global PMIs. So, where do we finish? Pretty close to the session lows, as it turns out. 0.7% lower on the CBO 200, 0.8% lower on the ASX 200. It is now back below 9,000 points. And for the week, in fact, we are marginally higher. In fact, just checking out the ASX, looks as though we have finished about 0.4% higher across the course of the week. Well, that is this Friday. That is the COB. Thanks for watching and listening. We'll see you again next week.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.